So we'll start the session in a minute or so.
Great.
Okay, I think it's 12 now, so we can begin the session. Hello everyone. My name is Rishi Bhatia, and I will be hosting today's NoCA's free CPD event. NoCA is an independent organization comprising of actuaries who work together to develop and share knowledge and aim to provide excellent service to the insurance and pensions industry. Today's session is titled Hyperinflation, Cattle-Based Micro Savings Product, and is presented by Kelvin Chamunorwa. Kelvin is a Zimbabwean entrepreneur and qualified actuary who trained in the UK before returning home to Zimbabwe. Kelvin studied and worked in the UK for 15 years. He was an actuary at Deloitte and then at Willis Towers Watson in London, working with pension funds with assets ranging from £50 million to £2 billion. He became a trusted advisor on risk management, actuarial valuations, and liability-driven investment strategy. Kelvin founded NoCA, a licensed life insurance company. NoCA provides innovative financial protection and wealth creation solutions to underserved consumers. Benefits are denominated by biological assets, starting with cattle, for real value preservation in a high inflation economy. Kelvin has been a member of the IFOA Council and has been editor of the Actuary magazine. Kelvin is giving this presentation in his personal capacity. The views expressed in this presentation are those of the presenter and are not necessarily the views of his employer or NoCA. The session may count for up to 1 hour of your CPD, provided it is relevant to the nature of your work or role and addresses a personal development need. You can register questions during the session on Zoom chat or by emailing contact@noca.uk. There will also be time for questions near the end. So with that, I would hand over to Kelvin for a very interesting topic on microinsurance. Kelvin, over to you.
Great. Thank you very much, Rishi. I hope you can all see me and that you can hear me okay. It is such a pleasure to be interacting with friends, former colleagues, some current colleagues in the UK. And as Rishi said, I spent a lot of time there, right from uni all the way through to leaving 6 or 7 years ago to come back home. But really, the UK is very much my second home. It's a country that I found very welcoming to people from outside of the UK. And it's a country that I feel like I developed as a professional and matured in. And so I really have a deep fondness for the country and for the actuarial profession. As you know, I've spent a lot of my own personal time serving it in various capacities. And so, thank you once again, Rishi. Thank you, James, for inviting me. And it's such a pleasure to be spending the next hour with you. So NoCA. NoCA is a passion project. I think we can start by what the meaning of NoCA is. So NoCA is a Shona word. Shona is one of the native languages in the north of Zimbabwe, where I come from. And NoCA means heritage or legacy. So it has a long-term aspect to it, which talks very well to the long-term nature of the products that NoCA offers. The whole idea behind NoCA was one of really led by a desire to improve poor people's lives. So as you know, the African continent has had its challenges, it's had its political challenges. There was a lot of that was largely solved over the last 5 or 6 decades through independence. And then came a lot of economic challenges, which it's still going through. which is not unique to Africa alone. I know there's a lot of turmoil happening in global economies more globally, but really Africa, from a developmental perspective, is further behind what I worked a lot on in the UK. And so as a result of that, you have a very large part of the population which is underserved. And it's underserved in many respects. What I know is I know finance. And so from a financial perspective, really NACA's whole raison d'etre was around why, answering a question, which is, why is it that some of the poorest people in the world don't have things like insurance, yet they probably need it the most? So the reality is, when a breadwinner dies, the lifestyle of the family immediately changes. Children have to come out of school. Families have to eat from going from 3 meals a day to literally 1 meal a day. So the impact of life events or bad life events happening is far more acute on the lives of low-income households than it may be for people like us here on this call. But yet those people are largely left out of formal financial services. And so really NACA was born out of a desire to serve those people. Before I moved back, I did have discussions and conversations with international insurance players, some of whom serve in Africa, to say, why is it that there's no appropriate products being offered to this market? And the response was typically around either country risk. So the view was that it's far too risky to operate in some of these markets, and it's very difficult to get the returns from capital to repatriate them back out. So country risk was a big one, and the political uncertainty what was the big one. And the second one was, well, is there really a business case? So if you're serving very poor people and you're offering $1 per month policies, the margin is so thin that there's probably no business case there. And so those were really the two main reasons that I was given. And so then decided, well, do you know what? I'm going to try, or I'm going to do it. And I believed that if you can target the lower income with products that are affordable, simple to understand, accessible, and relevant to their context, and you can reach millions, although the margin is thin, in aggregate, there is a case, and you can serve them in a profitable and a sustainable way, was my belief. Nobody else believed me, so I did it myself. But the whole point is, we want to prove that this market can be served appropriately and profitably. And our hope is that global financial players will then invest capital into areas like Zimbabwe and into the target markets that we are aiming for. So I hope that helps as background into what is this all about? Why would I leave a lucrative career in a very comfortable environment and come to back home where things are not so easy? And really that's the driver there. So what have we done so far? What we've done so far is we've now built a registered, so it's licensed by the local regulator here in Zimbabwe. The company now has a presence in the north, the Midlands, and the south of the country, in the capital city, Harare, but also in Masvingo, which is in the company, a team of 15 experienced and qualified professionals. So these are a mix of accountants, client relationship managers, we've got some bankers, we've got policy administrators. So it's really a dynamic, well-qualified and highly productive team. And the intention is that we keep the team very lean, and then we leverage technology, because remember I said this is all about reach. So the business case is met through reach. And the way you can more efficiently reach people is by trying to leverage either mobile technology or indeed in-house policy administration technology. So today, NoCA serves close to 70,000 lives in Zimbabwe. So these are about maybe 30,000 policies, but really we cover 70,000 lives through our insurance and long-term investment products. And because there's a monthly premium coming in, it is a very data-rich operation, and hence the automation comes in very handy. But really the main point there is we want to lower our cost of operation so much that we can then pass on those savings to our clients through lower premiums. And of course, we are now regulated. And then in 2020, so a couple of years ago, we were recognized by quite a credible organization, actually, which is Old Mutual, one of our biggest competitors, and a newspaper, a local newspaper called a local business, private business newspaper called the Financial Gazette, where they believe that NoCA is one of the top 3 performers, at least in that year. And this wasn't one of those surveys where they come and they interview you and you prepare packs and you pitch and you tell them how wonderful you are. All they do is they look at publicly available information. Because we're a regulated entity, we have to publish our numbers, our results, our governance process and procedures online, so anyone with a connection can access it. And so they use publicly available information to assess and award. And interestingly, I'm just hearing that in 2022, we're also a top 3 performer, but that's yet to be confirmed. So we're starting to get recognized for our operational excellence. But remember, this is really about reducing or being very efficient on the op costs to be able to pass it on and achieve affordability for the client. And then most recently, something that we're really excited about is NoCA-Nhaka Falami. NoCA-Nhaka Falami means my legacy in Shona, and then in Ndebele, which is the other native language. So NoCA-Nhaka Falami, my legacy, my heritage. The cattle-backed program that we've built, and which I'll talk about as we go along, has now been recognized by the government of Zimbabwe as a project of national priority. The reason being, we are in the agricultural value chain through cattle, and so we are increasing the national cattle herd. We're providing a wealth creation solution to the generality of Zimbabweans. And so that's been recognized as such. And of course, it comes with a number of incentives which make it easier or achieve this systemic impact that NoCA was created to achieve. So that's just a brief history of NoCA, where the whole idea came from, what the driver is, and then what we've done so far. So coming to the challenge that we are trying to address here. And remember, in startups and in entrepreneurship in general, what you need to do first is very clearly articulate the problem as you see it, right? So before even thinking about the solution, it's important to be ultra clear about what is it that's wrong. Because in doing that, you then create constraints which then allow you, as you come up with a solution, to be very, very creative. So it has to be very specific about what problem it is that you see before you then go to how you're going to solve that. So let's talk about the problem just to give some context here before I go on. I remember coming to Zimbabwe and having a discussion with one of the regulators who's now become a good friend. It was number 2 to the main regulator. And I'd just come off the plane from London. It was a rainy season in Zimbabwe. So I walked into the office, said hello, and said how awful the weather is. It was absolutely chucking it down. And then he took offense. He took offense because although he's also a professional, he's a farmer, like the majority of Zimbabweans. And his offense was, what is your actual problem with the rain? We need more rain for my crops at my small farm. So it's in that I then realized, well, I knew this, but I realized that actually agriculture is the bedrock of the Zimbabwean economy. It employs 60, maybe even 70% of the population. It contributes significantly to our GDP. The location of Zimbabwe is one where the climate is almost perfect. The soils are amazing for a number of different agricultural activities, be it crops or livestock. And so agriculture is absolutely core, and probably even the reason for some of the problems we're seeing in Zimbabwe now is at the absolute core of our country and our economy and our ability to produce and uplift ourselves out of poverty. However, because of a number of reasons, there has been very low investment in Zimbabwe. These are issues around some of our colonial past and the land issues we've had, and the fact that there's not much security of land, and so you can't really bank your title deeds for agricultural land and get a loan from the bank in order to then invest that into your agribusiness. And so that's one of the reasons. There's a few more, but the fact is that there is very little investment going into agriculture. Yes, there's banks, but again, even if you find other security, the banks work on very short-term loans, so maybe 12 months. But if you're breeding cattle, as we are, what you need is really a 10-year facility, but they'll only give 12 months. So you've already got a mismatch between your funding and the profile of the underlying business. So there isn't very much money going into agriculture, and that results in agricultural productivity not being anywhere near as high as it has been or as it could be. And so that's one problem. And then the second problem you have in this country is that there are very few wealth generating products that grow in real terms. And so I'm sure you're all familiar with the recent history of our macroeconomic performance, particularly around hyperinflation and some of the currency reforms we've had. But it's been very difficult for our government to control and stabilize inflation. In fact, I think we're probably one of the highest, we probably have one of the highest rates of inflation right now, even. Let alone 10 years ago, as most of you remember. So remember, this is a context where prices are changing, not every year, but literally, or every day, but sometimes 2 or 3 times in a day, right? And so for a long-term investor, you can see how not having appropriate assets can very quickly start to destroy wealth. And there just isn't many options for where an investor can put their money into. And then finally, our national cattle herd, which used to supply Europe and many other parts of the world, has really been decimated as a result of some of these things, and the quality of it is not great anymore. And so you don't really see Zimbabwean beef on dinner plates in the places in the world that it used to be. So you've got these 3 main problems that are happening, and as I see them at NACA. So in terms of the solution, what we've then, I hope you can still hear me okay. There's a big machine that's just gone on down the road. But what we're doing is we are, as NACA, we are using this company and entity to mobilize domestic investment from institutional investors such as pension funds, but also from individual retail low-income consumers, to the extent that they're not already aggregated under a pension fund. And we are then deploying that investment into the agricultural value chain by investing in, firstly, beef cattle. Now, the question is, why beef? And there's a lot of other things that it could be. Why cattle? For us, we love beef cattle because, first of all, it's not as intensive as trying to do crops. So all you need mostly is water and grass. There's very little infrastructure beyond fencing and a race for them to be vaccinated in. So it's a very low, easy entry agricultural space to get into. The second thing is, in one cow, you can put in a lot of value. So if you were to spend the same amount as you do on one cow in, say, goats, you may need 5 times more goats for the same cow. So you're able to put more value into the one unit than you could with other aspects of agriculture. And then, crucially, traditionally, Zimbabweans, and I'm sure in many other African countries, have seen beef cattle and used beef cattle as a store of wealth. So it's a culturally relevant commodity. So to the extent that when I present to some of our low-income clients and I say, this is the solution we've built for you, as we did over the last few years, the first question they ask is, what happens when my cow dies? So they already understand the risk aspect of it. And so we then say, well, there's livestock insurance, so we are able to guarantee that any losses will be compensated for, right? And then you see him nodding and say, oh, okay, yes, I get that. And then the second question then becomes, what happens to the calves? So the market immediately understands that the return through the biological asset is through calves. And their question is, how is that return being shared between them and I guess NoCA as the product provider? And then we say, no, the majority of the returns are for you because it's your capital. And then we have a minority of it because we want to build a sustainable business so we can continue to provide this solution to you. So it's in that very basic 2-minute conversation that they already understand the risk and they already understand the return because they've got a personal experience with it. Unlike if we were trying to sell exchange traded funds or rather such fancier instruments. And so that's why beef cattle. And because of the issue of inflation and currency uncertainty, we then denominate the investment in terms of cattle. So if it's a pension fund, which is aggregating on behalf of its members, then it's the number of head of cattle. That's what your investment is. So your quarterly statement starts off with number of head of cattle before we go into what the monetary equivalent is at that time, because your investment is an actual head of cattle, which biologically produce. And as those calves are born, they're credited to your policy. So the increase in your head count goes up, or the number of your head count goes up. So it's denominated in cattle, not in monetary terms, because as soon as you put the money in, we immediately convert it into cattle. And then if it's a retail investor, then it's then denominated in kilograms because we needed a smaller unit that allows someone for as little as $10 a month to be able to get a chance at wealth creation in a way that there isn't any similar product or access to that we can see in this market. So it's a cattle denominated product, and it is backed by a live herd of cattle, which is owned and managed by NoCA at its farms about 1 hour away from Harare. So this is not virtual cattle or tokens of cattle. There are actual live animals grazing right now, which are backing every single head on the policy that we give to the pension fund, or backing every single kg that we allocate in the investment account for the retail investor. And so the interesting thing is, as you start to run a cattle operation, as we've now been doing for almost 18 months now, there is now additional opportunity for systemic impact beyond the wealth protection, wealth generation. And that is through now starting to capacitate smallholder farmers surrounding the farms that we work on. And so remember I mentioned they don't have much money, they don't have a lot of expertise, but this is the community from which we employ. And these are the people who are looking after our cattle. And these are the people who are learning international production standards so that tomorrow they're able to start to breed their own cattle in this way and potentially even feed into our markets as we create those for the actual offtake of the beef. So you've then suddenly got an insurance company which has clients and a product, and it's marketing, it's distributing, it's collecting premium in the way that I've described. It is backed by an agricultural concern, which is working with smallholder farmers, providing them with financial support, technical support, and allowing them to start to emerge as commercial farmers. And so really, it's the systemic impact, which is the whole point of this, which is now starting to come through this work that we're doing. So this is what we've designed as a solution. So if we then drill down further into exactly how it works, okay, so we've got 4 main steps which I'll talk you through. And the first step is, and here I've used an aggregated model. So I've assumed it's a pension fund that's investing, but remember behind the pension fund is hundreds or thousands of individual members. But just to make it simple, I've used a pension fund which is aggregated and said we're investing 100,000 on behalf of our members. So the first step is, as that money or that premium is received by NoCA, it is immediately converted into cattle. What I mean by that is we've got 1,400 head of cattle now at our farms. So when $100,000 come in, we will allocate 50 of our cattle, between 50 and 60 of our cattle, to that pension fund and its members. So each animal has got an ear tag, so it's uniquely identifiable. And so we then assign those 50 or 60 ear tags to that specific pension fund. So these are animals which are already at our farm, hence the immediate part of it. And these are animals which are not allocated to any other pension fund. And so you're effectively investing in a segregated and identifiable herd. And that conversion is absolutely immediate because we can't have a time lag given how quickly prices are increasing. And so all those ear tags or the economic benefit of those 50 or 60 heads of cattle is all passed on to the pension fund, gross of the charges, which I'll talk about later on. And so really the fund, before charges, owns all of those cattle, and it owns all of the future offspring of those cattle. And most importantly, all of the future offspring of the future offspring of the cattle. Because by year 3, the female calves will start dropping their own calves. So you very quickly start to see a compounding of the growth. So in the first year, you've got the 50 or 60 which are giving birth to calves. In the second year, you've got that same 50 or 60 giving birth. In the third year, you've got the 50 and 60 giving birth, plus the first crop of calves are now dropping their own calves. And then every subsequent year, you've got a subsequent generation of female calves dropping their own calves. So you can start to see how, from a compound return perspective, it starts to look very, very attractive. And then we also offer some group life cover over and above the investment opportunity. And then every quarter, we provide independent reporting, including a list of the ear tags which are backing the investment. And we encourage members and trustees to actually come to our farm to demonstrate that their investment is in a live and tangible commodity and not in local currency, which is depreciating very, very quickly. And then through livestock insurance, we guarantee that the head count doesn't reduce, or if there's a death, which of course there will be, we then replace the animal, or replace the air tag with another animal. And so we can guarantee that there will be no reduction in headcount. And then there's flexible liquidity options where fund can make additional investments either monthly as they're collecting the pensionable contributions, or indeed quarterly or ad hoc. And then after 3 years, once you start seeing the compounding, we then allow the fund to make partial or full withdrawals, either as members retire or as cash needs require. And then we offer short-term loans as well, which are backed by the value of the cattle investment. And so what's interesting is through this, we've actually built another business, which we've called Chikwama. And Chikwama in Shona means wallet. So we've built a mobile payments wallet on the back of this. And through that, we also provide loans to these low-income consumers. But now we're not applying usurious interest rates because their loan is secured by the kilograms or the number of head of cattle they own, which are in our control. And so the credit risk is then much lower, and that feeds through in the interest rates that we're able to offer, which then are affordable. So I find it interesting because through NoCA, we started a cattle operating business and also a lending business as part of that, which is exciting. And then in 60 months, the investment then matures, at which point the fund can either withdraw for cash, withdraw the actual live weight cattle because they're there, or roll over into another policy term. So in terms of the way we've structured the pricing model is the context in which we're working is one of distrust of formal financial services. It is one of suspicion, particularly for new things, because you can imagine there's a lot of fads that come up. People lose money. So beyond just inflation, also through fraud. And so there's always a level of skepticism around new and innovative products like the one we are doing. And so what we've tried to do is structure in a way that our charges and fees are very closely aligned to the incidence of how we incur the costs that we're collecting those fees for. Okay. So what I mean by that is because we've got a value chain in bringing these cattle in, some of them are imported, but there's a whole value chain in actually acquiring cattle stock, which is quite complex actually. So I think, I've told you kind of the simple overview of it, which sounds very simple and very elegant, but beneath that is incredible complexity. So there's a whole value chain. There's a whole land requirement, because for every head of cow or for every one cow, you need anywhere between 3 and 5 hectares, which is anywhere around maybe 6 and 10 acres for one animal. So the amount of land you need to hold for grazing purposes is massive. And so in that is a whole land acquisition, land management, pasture management requirements. There's then labor, because the animals need to be looked after, they need to be fed, they need to be vaccinated, they need to be dipped. At night, they need to be secured. So there's a whole labor force which is supporting this operation of about 1,500 odd head of cattle. Nutrition, particularly in our winter. So we're now in winter, where the pasture is a bit dry. It's a dry time of the year, so we need to supplement feed. They need to be fed, so you can see one which is feeding on the picture there, and the whole herd health. So there's a lot of complex management of the actual asset that's required, and there's a cost to that. And so we pass on that cost to the pension fund by deducting it from their investment account. So what we don't do is go to them and say, here's your invoice for this year's cattle management fee. We just charge it to their account, so we effectively earn it in cattle form, effectively, rather than in cash form. So NoCA provides the cash, and we then recoup it from the investment account in the form of cattle. And then there's an actual platform. So number one is kind of the operational on the ground infrastructure, management, health and nutrition. And then there's the platform. So these are the things you get because you're owning cattle through this modern product. So things like the fact that we have to report every quarter, there's a cost to that. The fact that there's independent oversight around our tagging system, around our market valuation of the cattle, and then of course the livestock insurance, which comes with it. Now, both of these costs, because we've got such a large herd, are a lot lower than an investor would have if they were trying to manage 50 or 60 head of cattle on their own. So, and we pass on that cost. And so these rates that you see here are actually the economies of scale rates that we pass on to our clients so that the product is that much more affordable. So number one and two really meet a cost that we already have to incur. And so there's really no marginal profit there. And where we do make our marginal profit is really from number three, which is the performance fee. So we then say out of the calves that are born or the increase in their investment return in real terms, NoCA then has a 40% performance fee, which is a minority of the return because it's really the investor's capital that's at risk. But for us, that's then the clean profit, but it's driven by performance rather than upfront costs and upfront charges, so that us and our clients are fully aligned. And so it's a 5-year term, as I mentioned before. So that just gives you some idea of how we price the product and why we price it in this way. I'm conscious Rishi wanted to leave sufficient time for questions and comments. So I'll wrap up through the slides to bring it all together. So what we've done on this slide is show really from a financial projection perspective how this looks from the investor's perspective. And so on this slide, really the main driver of the investment return is the calving rate. So this is the proportion of cattle each year that drop a calf, right? Because remember I mentioned you get the preservation of value by denominating it in cattle, and then you get the investment return over and above that through the calves that are naturally born, and then the calves of the calves, which increases consecutively from about year 3 onwards. So what we then do here is we put it into monetary terms using US dollars, because I won't call it a stable currency. I'll call it a more relatively stable currency to the local currency at least. So we use US dollars to try and illustrate what this all means from a financial returns perspective, having understood the mechanics and the pricing. So calving rates is one of the main drivers. And so if we look at, say, the 75% calving rate line, the assumption there is out of every 100 heifers, which are female productive cows, we expect 75 calves to be dropped, of which, of course, half will be female and half will be male. So with an initial investment of $100,000 US, the cattle management fee quarterly is just over 90,000, and then there's that platform fee, which is about 31,000, and then the increase in the gross asset value, which is the value of these calves which are coming through and growing and delivering more calves, is about $410,000 over the 5-year period. And then, of course, NoCA then has a performance fee, which is 40% of the increase in the gross asset value. So not of the gross asset value itself, but of the increase in it beyond the initial investment. We then take off the 164,000, which is 40% of the 410. And then the net investment amount that goes back to the investor at the end of year 5 is almost $250,000. Through that, you're delivering a compound annual growth rate, broadly net of inflation of about 17% per annum. So this is very illustrative, but it just then gives you a view of what the returns look like. And so we include the 45% there, but the reality is, if you're a commercial breeding cattle farmer, and you're having carving rates of about 50%, there's probably very little management that you're employing. There's very little management that you are spending any money on. And so really 45, 50% is absolutely the bare minimum. And if we see those sorts of carving rates on our own herd, there will be interventions that we put in to ensure that we're somewhere between 75 and 90 or beyond. And so from a risk perspective, we manage the risk downwards. And from an upside perspective, we intervene to ensure that the carving rate is much closer to 75%, 90% than to 50%. But still, we show that with very little management, you're getting about an 8% CAGR on net of inflation as a return, which compared to other asset classes which are available in the universe, it is still very compelling. So really, there's a long-term capital growth proposition to this. So this is not generating yield. This is not an income generating product. It's a capital appreciation product driven by the underlying biological asset and its life cycle and its breeding and production cycle. And we're coming out of the monetary financial system because your account is denominated in cattle. Your returns are driven by the production of cattle, not by currency or anything which is controlled or centralized. And of course, the biological asset naturally multiplies. And then really, because we're in beef cattle, of which we've got access to global markets, you then diversify your portfolio away from the local macroeconomy. So beef prices can do very well, and the GDP is not the local GDP is not highly correlated to the price of beef, of which there is a lot of demand for it globally, particularly in the market that we work in, because we work with pedigree cattle, which are cattle of the highest genetic quality, because of this objective to improve not just the quantity but also the quality of the national herd. And so what we find is in that high quality beef pedigree stock market, there is very high demand for that globally, and we can access that, and so that allows diversification for the retail investor and the pension fund. And then of course it's an attractive return profile. I think there's a number of return profiles, but this one is one where the downside is well managed or insured, and the upside is highly likely to be a double-digit one in real terms. So you're not going to go 10x as if it's private equity, say, but you're going to have a fairly stable double-digit growth, which has got a very well-managed downside. And so I think it provides quite an attractive portfolio and very different to other asset return profiles in the country. So I'll stop there and hand over back to you, Rishi. I hope you heard everything, and I look forward to the discussion.
Thank you, Kelvin. What a fantastic presentation. I mean, it's amazing to hear from you from the ground, on the ground, how you have put this company up and running it and providing such a fantastic product and service to the underserved customers in Africa. So thank you for taking us through the various aspects. I can already see that there are questions people have posted on chat. So I will go through them first, and people can post questions as we go along these questions. So the first one, Kelvin, is from James. Is it possible to invest in this product from the UK?
At the moment, no, unfortunately, James. So it's very much targeted initially at the low-income clients and refining that for them, because that was the whole point of this. But of course, we will not turn away other market segments, but we initially want to make sure that we refine it and we perfect it for the people who it was meant to serve, and then start to allow access to others who may be interested in it. So not at the moment, James.
Thanks, Kelvin. The next one is from Sujay Shah. He's asking if there is distinction in the quality of cattle in the policy, or by definition, are all cattle covered one type? Example, within beef cattle, he's saying there is varying quality of type of cattle.
Yeah.
So,
So
there is
so the
distinction.
so the cattle we have are of, it's pretty it's relatively homogeneous in terms of the actual quality and type and profile of the animals that we have. The differences will be mainly around breed, and those which perhaps produce more meat versus those which produce more milk. There tends to be a bit of a trade-off there, but they're largely of a homogeneous sort of quality, homogeneous sort of size beyond the breed. Because what we want to do is we want to make the operation as efficient as possible and as scalable as possible as well. And so we believe we get that by going for a very similar type of animal, albeit the breeds may differ. But really what we want is, because it's a capital growth investment, we want animals that are fertile and for 7 years of their life will drop a calf every single year. And then we replace them. So I hope that answers that question.
Yeah, very interesting. Thanks, Kelvin. Next one is from Yvonne. She's asking, I imagine there is quite a concentration risk as all your cattle are being kept on one farm near Harare. How are you mitigating that? What insurance or reinsurance do you have in place?
Yeah, so actually they're not being kept in one place. So they are 1 hour in Harare, but they're actually kept on about 5 different farms, which are separated by perimeter fences, and they typically do not interact. And so that's the one farm, that's the one sort of location 1 hour from Harare. And then we've also acquired another location further down country in the middle of the country, where we've got 2 farms there, which are about 30 k's or so, 30 kilometers or so, or 20 miles away from each other. And again, they're secluded by that. So we do try to diversify our holding both in the same area, but also across the country, to manage just that risk that you've identified, Yvonne, which is an important risk.
Okay, and do you have any reinsurance in place?
So we go to a direct insurer. So there's a general insurance, and so not NACA. So there's a general insurance entity which we insure the livestock against, and then they access the reinsurance markets. But it's an interesting question, though. That's Yvonne still, right? It's an interesting question, because we're now getting to the point where our herd is big enough that we're starting to seriously contemplate going direct to the reinsurance market. And the reason we're looking at doing that is because we're much better able now, with a bigger herd, to predict our losses, mainly mortality, really. And we are, therefore our appetite for some upside on the premium is increasing. And so that's something that we're looking at, is actually accessing the reinsurance market directly, and then benefiting from good experience in a way that we're not doing now. Yeah, but something that we're actively working on. Great point. Thank you.
Okay. Next one is from Alejandro. He's saying, very interesting proposition. Which risks are not covered by insurance? Example, political violence, war, cattle starvation due to drought, or famine.
So it's mainly, it's quite a comprehensive livestock insurance policy. But the main ones that wouldn't be covered are mainly around, that sort of sabotage, and, someone actually coming on and, shooting every single head of animal. And so we manage that through security, and just the geographic diversification as well. But most of the main risks we face are around really disease. So an animal gets sick, We inject it, we give it the medication, but it just can't recover, and we lose it from that. Or injury, that perhaps they're at the water trough and one headbutts the other on its leg, and it just doesn't heal. So really, our main losses are from natural mortality, which are comprehensively covered. But so is things like theft, although we haven't experienced that much. Predators like hyenas, so particularly in the Midlands, that threat is higher than in the north of Zimbabwe, and our insurance policy covers that.
Okay, the next one is an interesting one, quite topical. It's from an anonymous attendee, and they're asking, as the business grows and the herds of cattle grow over the longer term, do you think that the business model poses a climate change risk?
That's a really good question, and it is something that we are starting to consider now. I must admit, it's not something that we've considered in great detail. We have just been focusing on protein and the requirement for more protein, initially locally, but also in other emerging markets like China, Southeast Asia, and the Middle East. But it's not something that we've assessed in any great detail. But I also want to then raise another point, which I didn't in my presentation, on the back of that really good question, which is that we've built this, and the way we see this, right, is we actually see this as a platform, of which cattle is one of the products on the platform. And so what we've been trying to do now is, from a market perspective, not get the market to start to think that NoCA is just an agricultural player, right? And so we're now starting to build other products that we're going to put on this platform beyond just beef cattle and beyond just agricultural products, right? Because you can see how this can apply to many, it can apply to property and, denominating in square meters. It can apply to many different things. And so what we've done is we've built a platform of which cattle or agriculture in general is all but one product on that platform. And so I think, it is a good point about climate change, but the scale may be beyond just cattle, but to also other things which may potentially balance out that risk that has been well raised.
Next one is from Nikos. Is there a capacity ceiling for this type of investment? Example, amount of land or resources?
100%. So our main constraint, and the thing I think about and work on the most, is land. That is by far the greatest constraint to scale. There's only so many square kilometers of land in Zimbabwe available, period. And so because of that, there is naturally a cap on the supply of this product. And it can open up interesting questions like, do we then create a secondary market, right? So is there a way to then allow, I suppose, liquidity, perhaps, additional upside on the basis that you've got a product or a commodity which has got limited supply, and you can get additional return over and above the 17 or 22% that I've illustrated. But yes, I agree. Land is by far the greatest constraint to this. But fortunately, we're still growing and we're still able to get land, and we don't yet have a feel, although we're trying to. We don't yet have a feel as to where that absolute cap is. But again, another really interesting point. Thank you.
Next one is from an anonymous attendee. What would happen if there was a disaster and all the company's cattle died?
Sorry, I didn't get the last part of the question after the disaster.
Yeah, what would happen if there was a disaster and all of the company's cattle died?
If there was a disaster and all the company's cattle died, that's a very, very good question.
Yeah, very extreme, yeah.
Yeah, it's interesting because it'll be interesting as to what has caused that. Because remember, we're across a dozen farms across a whole country. To the extent that insurance pays, I suppose that is the risk. But there is equity backing it, right? So behind the actual tangible asset and behind the insurance policy is an actual balance sheet, which is held by NACA beyond those assets, which probably would then come in. There's a bit of a cash float as well, which I mentioned that we use for the lending. So yes, I suppose there are, I haven't thought of it in that way, but there are a number of degrees of protection ultimately backed by NACA's corporate equity.
Okay, thank you for that. Next question is from Uneet. They're saying hyperinflation. Please, can you provide clarification on what it means and why it's linked to capital investment?
Okay, so a heifer, spelled Heifer, a heifer is the biological word for a young female cow which is ready for a bull and therefore to deliver a calf for the first time in about 9 months. So a heifer is a young cow which is just about to go into its breeding life. And so the Heiferinflation is a play on how we're using young female cows in a hyperinflationary environment to protect real capital and drive growth. So it's a play on heifer, and it's a play on hyperinflation, which is why we say Heiferinflation to try and be funny, I suppose.
Okay. Questions are coming in thick and fast. I think we have time for maybe a couple of more questions. There's another one from an anonymous attendee. With a calving rate, isn't there a danger of running out of space, etc.? Also, can this model be exported to other territories such as South Asia?
Yes, exactly. It's the same point as the land constraint, that yes, you've got a constraint on land for your organic growth, which is the additional calves coming, but also inorganic growth as you purchase more stock ready for new investors to be able to acquire over time. So absolutely.
Okay. Next one is from MW. He says, very interesting, thank you. How do you handle the indivisibility of the asset, given the investor has their name tab on the cattle? Example, when you apply charges.
Yeah, so remember, there's the heifer or the cow, and then there's the calves, which start off as calves suckling, and then they become weaners, and then they become heifers, or they become yes, there's one unit, but there's also it in itself is also divisible through the sort of the biological life cycle of it. So there's enough there to be able to run. And remember, because the pension fund is aggregating, it makes it a lot easier because they're not withdrawing, $10 or half of a cow or 25% of a cow. And so it's much easier. So which is why when we then access the retail market, we denominate in kilograms to allow for that very fact that someone contributing $10 a month or withdrawing, $200, which may be less than the value of a full cow, we then denominate it in kilograms. And because it's an asset that NACA is very happy to have and keep, we can round it appropriately to meet the policyholder or the client's requirements.
Okay, maybe last question from James. What happens if a cattle allocated to me as the investor gets sick or dies?
Yeah, so if the cattle gets sick or dies, then because at any point in time, right, over this herd, probably a third of it is unallocated, which means a third of it is under NACA's account and to be allocated to a future pension fund. And then the other 2/3 have already been allocated to specific pension funds. So there's always quite a high proportion of unallocated herd. So when yours dies, James, so say your tag number 1384 dies, we will replace 1384 on your account with 1629, which is unallocated and is of equivalent profile and value. So what you'll see on your quarterly report is 1384 is no longer there. It's been replaced by 1629. And then we'll explain, oh, that's because 1384 died because, you know, she broke her leg and wasn't able to graze, and then she passed away, but we've replaced her with 1692, and therefore you're not prejudiced. And then once we've done that, we then go to the insurer. And of course, insurers take time. And then that claim is to replenish NACA's unallocated stock. So we're able to immediately replace yours upon death, and then we then replenish the unallocated stock over time.
Okay, excellent. I think that's all the time we have for this session. Kelvin, thank you. Thanks so much from myself and also from all the participants. I think there was quite good active participation in the end in the Q&A session. So from everybody, I would like to say thank you to you for bringing this very innovative and interesting product summary for us. And we wish you all the best for your firm.
Thank you.
And this product. So it definitely looks like it'll go places. And I would also like to thank our participants for joining the session. So thank you, everybody. All right, thank you.
Thank you so much, and goodbye.
Goodbye.